Imagine waking up tomorrow and checking your bank account. The number on the screen feels solid, real, like something physical. But here's the uncomfortable truth. That number is not money. It's an agreement, a shared belief, a digital promise floating inside a network of computers. And that promise only works because everyone else agrees it works. Money isn't paper. It isn't coins. It isn't even the digits in your banking app. Money is trust at scale, the biggest collective agreement in human history. Long before skyscrapers, stock markets, or banking apps, people tried to trade directly. You had grain. I had tools. If I didn't want grain, the deal died. Trade stalled constantly because people rarely wanted exactly what the other person had at the same moment. So humans created a workaround. We started using things everyone agreed had value: metals, salt, livestock, items that were widely desired and durable. Eventually, metal coins became standardized, and suddenly value became portable. Wealth could move. Then paper entered the story, not as money at first, but as a claim check, a receipt that represented metal stored somewhere else. It was lighter, easier, more efficient. For a long time, paper money was tied to something physical like gold. Governments promised that if you brought the paper back, you could exchange it for metal. That promise created discipline. It limited how much money could exist. Then one day, that link quietly disappeared. Modern currency is not backed by gold. It is backed by confidence, the full faith and credit of a government, which sounds abstract because it is abstract. Today, most money doesn't exist physically at all. It's not stacked in vaults. It's stored as entries in databases. When you get paid, no cash moves. A ledger changes. When you swipe your card, no bills travel across the country. Servers update. If you really zoom out, the entire financial system is one massive digital accounting structure built on belief. Now ask yourself something. If money is belief, who controls how much belief exists? That's where central banks enter the picture. Most people never interact with a central bank directly. You can't open a checking account there. You won't find an ATM. But these institutions quietly influence almost every financial decision in your life. They adjust interest rates. That single lever affects mortgages, car loans, business expansion, credit cards, student debt. Raise rates and borrowing slows. Lower rates and borrowing accelerates. It's like adjusting the temperature of the economy. But interest rates are only part of the story. When crisis hits and rate cuts aren't enough, central banks can inject money directly into the system by purchasing financial assets. Not by printing truckloads of cash, but by creating digital reserves. New entries on balance sheets. Fresh liquidity. This power is enormous. It can prevent collapse. It can also create distortions. When too much money chases too few goods, prices rise. Inflation becomes the bill that shows up later. The difficult part is timing. Economic policy works with delay. Decisions made today ripple months later. Steering an economy is like driving a massive ship through fog with lag in the wheel. Every move involves trade-offs. Now zoom in from central banks to commercial banks, the ones you actually use. Here's something that surprises most people. When you deposit money, it does not sit untouched in a vault labeled with your name. Banks lend most of it out. Your deposit becomes someone else's mortgage, or business loan, or car purchase. This process expands the money supply. Loans create deposits. New money is born from promises to repay. Banking is profitable because of the spread between what banks pay depositors and what they charge borrowers. That difference funds operations, salaries, expansion. But there's a vulnerability built into the structure. If too many depositors demand their money at once, banks cannot instantly provide it. Not because they're evil, because the system depends on confidence. That's why deposit insurance exists. It's a psychological firewall. It reassures people that even if a bank fails, their insured deposits are protected. Without that assurance, panic spreads quickly. And panic today moves faster than ever. Bank runs used to involve lines outside buildings. Now they happen through smartphone apps. Billions can leave an institution in hours. The financial system is more digital, more interconnected, and more fragile in speed than most people realize. Now step into a different part of the system. Investment banks. These institutions don't serve everyday customers. They serve corporations and governments. They help companies go public. They arrange mergers. They raise massive amounts of capital. When a private company wants to sell shares to the public, Investment banks orchestrate the entire process: pricing, marketing, institutional demand, legal structuring. It's complex and highly profitable. They also advise on acquisitions. When one company wants to buy another, investment banks help value the target, negotiate terms, and structure financing. Billions can change hands in a single deal. The incentives here are powerful. Fees are tied to transaction size. Bigger deals mean bigger paydays. That structure encourages activity. Sometimes that activity creates growth. Sometimes it creates excess. Beyond investment banks are hedge funds, private pools of capital for wealthy individuals and institutions. They operate with flexibility. They can bet on stocks rising or falling. They can use leverage. They can trade complex derivatives. Some hedge funds outperform dramatically for periods of time. Many do not. Over long horizons, broad market index funds have quietly beaten most active managers. That reality reshaped investing. Instead of trying to outsmart the market, index investing simply buys the entire market. Low cost, low friction, minimal trading. Over decades, the power of compounding combined with low fees becomes incredibly difficult to beat. Fees matter more than people think. A small percentage difference compounded over decades translates into massive wealth gaps. Now shift to another powerful but less visible player: private equity. Private equity firms buy entire companies, often using borrowed money. The acquired company carries the debt. The goal is to improve operations, increase profitability, and eventually sell at a higher valuation. Sometimes that transformation genuinely strengthens companies. Other times, the debt burden creates strain. Financial engineering can either unlock value or destabilize it. Venture capital is different. It funds early-stage startups. Most of those startups fail. A few succeed spectacularly. Those few outsized wins make the entire portfolio profitable. The venture model is built on asymmetry. Many losses, rare but massive gains. Meanwhile, pension funds and insurance companies sit quietly managing trillions. Insurance companies collect premiums upfront and invest them until claims are paid. That investable pool, often called float, becomes a powerful engine. If managed well, it produces substantial returns over time. Pension funds promise future income to retirees. They invest contributions in stocks, bonds, real estate, private equity. Their assumptions about future returns determine whether those promises are fully funded. When returns fall short, gaps emerge. Those gaps don't disappear. They shift to taxpayers, to workers, to future policy decisions. Then there is the shadow banking system, financial entities that perform bank-like functions without traditional banking regulation. Money market funds, structured investment vehicles, private credit funds. They borrow short-term and lend long-term, just like banks, but without the same safety nets. In calm periods, this system hums along efficiently. In stress periods, funding can evaporate quickly. The global financial system is deeply interconnected. Stocks influence retirement accounts. Bond markets influence mortgage rates. Central bank policy influences bond markets. Pension allocations influence equity demand. Insurance portfolios influence fixed income flows. It's one giant loop. Derivatives add another layer. Contracts whose value depends on underlying assets. They can hedge risk. They can also amplify it. The notional value of outstanding derivatives dwarfs global economic output, though notional doesn't equal actual exposure. Still, the web of interconnections is dense. Complexity creates opportunity. It also creates opacity. History shows a pattern. Hidden leverage builds quietly. Confidence remains high. Something small triggers stress. Leverage amplifies losses. Interconnections transmit pressure. Contagion spreads. Crisis rarely begins where people expect. It begins where incentives quietly accumulated risk. After major crises, reforms follow. Regulations tighten. Capital requirements rise. Oversight increases. But financial innovation adapts. Risk migrates. It rarely disappears. Now we are entering another shift. Digital currency issued directly by central banks. Unlike cryptocurrency, these digital currencies would represent official legal tender in purely digital form. They could streamline payments, reduce transaction friction, improve distribution of stimulus. They could also raise profound questions about privacy and control. Programmable money changes incentives. Imagine currency that expires if not spent, or funds that can only be used in certain categories, or real-time oversight of transactions. Efficiency increases. So does transparency. If individuals can hold money directly with a central bank, commercial banks may face new pressures. Deposits are their lifeblood. Changes to deposit behavior ripple through lending capacity. The financial system evolves in layers. Physical coins, paper notes, bank deposits, digital transfers, algorithmic trading, programmable currency. Each layer increases efficiency. Each layer introduces new dependencies. Here's what matters most. You are already inside this system. Your paycheck flows through it. Your mortgage depends on it. Your retirement account rises and falls with it. Your job security connects to it. The system was not designed primarily for simplicity. It was built by institutions optimizing for growth, profit, and stability from their perspective. Understanding how it works does not require cynicism. It requires awareness. It means recognizing that long-term investing often beats short-term speculation, that fees compound against you, that leverage amplifies both gains and losses, that confidence is a fragile but powerful force. It means knowing that financial headlines are often symptoms of deeper structural shifts. The gap between people who understand the mechanics of money and those who don't can be expensive, not because the system is a conspiracy, but because complexity benefits those who navigate it fluently. The financial system is not a villain. It has financed innovation, infrastructure, healthcare advances, technology revolutions. It has also produced bubbles, crises, and inequality. It is neither purely good nor purely bad. It is powerful, and power without understanding feels intimidating. But once you see the structure, once you understand the incentives, the levers, the feedback loops, it becomes less mysterious. Money is belief. Banks multiply belief. Markets price belief. Central banks manage belief. And crises happen when belief fractures under the weight of leverage and interconnection. The future of money will likely be more digital, more instantaneous, more data-driven. The trade-off between efficiency and privacy will shape policy debates. The relationship between governments, banks, and citizens will continue evolving. The only constant in finance is change. If you take one thing from all of this, let it be this. Complex systems reward patience, discipline, and understanding more than excitement and noise. The financial world often looks chaotic from the outside. Inside, it runs on incentives, math, and human psychology. And once you understand those forces, you stop feeling like money is something happening to you. You start seeing how it moves. And when you can see how it moves, you make better decisions within it. That's the real advantage. Not secret stock picks, not inside information. Clarity. And clarity compounds just like capital, because once you understand how money is created and moved, the next question becomes more personal. Where do you fit into all of this? Every morning, millions of Americans wake up, go to work, trade time for dollars, and deposit those dollars into a bank without thinking about what happens next. That money doesn't sleep. It doesn't sit still. It moves. It flows through loans, through markets, through investments, through global networks of capital that most people never see. And here's the part nobody explains clearly. The system rewards certain behaviors and quietly punishes others. If you spend everything you earn, you stay at the edge of the machine. If you borrow at high interest, you feed the machine. If you invest wisely and keep costs low, you begin to own pieces of the machine. That difference changes everything over time. Think about debt for a moment. Debt is not inherently evil. It builds homes. It funds businesses. It finances education. But debt is leverage. And leverage is like fire. Controlled, it creates growth. Uncontrolled, it destroys balance sheets. When interest rates rise, debt becomes heavier. Monthly payments increase. Businesses cut back. Layoffs happen. Expansion slows. When rates fall, borrowing becomes attractive. Risk appetite increases. Asset prices rise. Most people feel these effects but don't connect them to the bond market or central bank decisions made months earlier. Now consider housing. Your home price is not just about your neighborhood. It's influenced by mortgage-backed securities, investor demand, construction costs, lending standards, and global capital flows searching for yield. When large institutions buy mortgage bonds, mortgage rates can fall. When they sell, rates can rise. A family in Ohio or Texas might See their borrowing cost change because of decisions made by traders in New York or London. That's how interconnected everything is. The same applies to your retirement account. When you invest in a broad index fund, you're buying small pieces of hundreds of companies. Those companies are influenced by consumer spending, corporate borrowing costs, global trade policies, technological innovation, and regulatory changes. It's one ecosystem, and ecosystems don't move in straight lines. Markets rise, markets fall, fear spikes, optimism returns. The media amplifies every move. But historically, long-term participation has rewarded patience more than prediction. Timing the market sounds intelligent. It feels proactive. But data over decades shows that missing a handful of strong recovery days can permanently damage returns. And those recovery days usually happen when fear is highest. This is where psychology becomes more important than math. Humans are wired to avoid pain. When markets fall sharply, selling feels safe. It feels responsible. But often the real damage happens after the emotional decision, not before it. The financial system doesn't just run on numbers. It runs on human behavior. Greed expands bubbles. Fear accelerates crashes. Confidence rebuilds cycles. Now let's talk about something even bigger. Global power. The US dollar plays a central role in global finance. It's used in international trade, energy pricing, and as a reserve asset by central banks. That status gives the United States enormous influence. But influence also creates tension. Other nations explore alternatives. Payment systems evolve. Digital currencies are being tested. Cross-border settlement systems are being redesigned. Money is no longer just economics. It's geopolitics. As technology accelerates, financial infrastructure becomes faster and more programmable. Real-time payments reduce friction. Blockchain experiments challenge traditional settlement models. Artificial intelligence analyzes market patterns in milliseconds. Speed increases, but faster systems don't eliminate risk. They sometimes amplify it. When trading is automated and capital can move instantly, stress can spread in seconds. Flash crashes have shown how quickly liquidity can disappear and reappear. The system is stronger than it looks in some ways. Capital requirements are higher than decades ago. Risk models are more sophisticated. Transparency has improved in certain markets. But complexity has also grown. When you combine leverage, derivatives, global interconnection, and digital speed, you create a structure that is both resilient and sensitive at the same time. Resilient because it has multiple shock absorbers. Sensitive because when pressure hits the wrong node, it can cascade. That's why awareness matters. Not to scare you, not to make you distrust everything, but to understand that financial headlines are surface ripples of deeper structural forces. When you hear about inflation, ask what expanded the money supply and why. When you hear about bank stress, ask what assets lost value and how they were funded. When you hear about a market rally, ask where liquidity is coming from. You don't need to become a Wall Street insider. You just need to connect cause and effect. Because here's the truth most people miss. The financial system is not separate from daily life. It shapes wages, job opportunities, small business survival, housing affordability, and retirement security. If you ignore it, it still affects you. If you understand it, you navigate it better. Now think long-term. Over decades, productivity tends to rise. Innovation compounds. Companies grow. Economies expand despite recessions, crises, and corrections. The arc is not smooth, but historically, it has bent upward. Owning productive assets has been one of the most consistent ways to participate in that growth. Productive assets are businesses, land, intellectual property, infrastructure. Cash loses purchasing power over time because inflation slowly erodes it. Investing allows your capital to work rather than sit. But investing without understanding risk can be dangerous. Diversification reduces dependence on one outcome. Low costs increase net returns. Patience reduces emotional mistakes. These principles sound simple. They are simple, but simple is not easy. The financial industry thrives on complexity. Complex products often carry higher fees. Higher fees compound quietly. Over 30 years, even a 1% difference in annual cost can translate into hundreds of thousands of dollars. That's not dramatic. That's math. And math does not care about marketing. Now let's return to the idea of belief. Every financial instrument, from a treasury bond to a startup equity stake, represents a claim on future cash flows. The future is uncertain, so valuation becomes an exercise in probability. Interest rates influence how we value the future. When rates are low, future cash flows look more valuable today. When rates rise, those same future cash flows are discounted more heavily. That's why rising rates often pressure stock prices. It's not magic. It's discounted cash flow math applied at scale. Understanding that connection changes how you interpret volatility. Instead of seeing chaos, you see adjustments in expectations. The same applies to corporate earnings. Companies borrow to expand. When borrowing costs rise, expansion slows. Profit margins tighten. Layoffs may occur. All of this loops back to central bank decisions, bond markets, and global capital allocation. You begin to see the system as circular rather than linear. Money flows out. It returns. It compounds. It contracts. Crisis resets excess. You start using it. And that shift from confusion to confidence is where real financial power begins. Because once you understand the structure, the real question becomes this: who actually wins inside this system over time? It's rarely the loudest voice. It's rarely the person chasing trends. It's rarely the one reacting to every headline. The consistent winners are usually the quiet participants who understand compounding. Compounding is not just a math concept. It's the hidden engine of the entire financial world. When companies reinvest profits, they compound. When investors reinvest dividends, they compound. When governments run persistent deficits with growing interest costs, that compounds too. Compounding works in both directions. If you carry high-interest debt for years, compounding works against you. If you invest steadily at reasonable returns, compounding works for you. Time is the multiplier. This is why long-term ownership of productive assets has historically outperformed short-term speculation. Businesses adapt. Technology evolves. Productivity increases. Even after recessions, wars, inflation spikes, and financial crises, growth has continued over long horizons. But that growth is uneven. Certain decades feel explosive. Others feel stagnant. Entire generations experience different economic realities depending on when they enter the workforce or markets. That's another truth about finance. Timing matters in the short run. Discipline matters in the long run. Now let's talk about inequality, because you can't talk about the financial system honestly without addressing it. Asset ownership is not evenly distributed. When markets rise, those who own more assets benefit more. When asset prices inflate because of low interest rates and liquidity injections, wealth gaps can widen. At the same time, access to low-cost investing tools has expanded dramatically. Index funds, retirement accounts, commission-free trading, fractional shares. The barriers to entry are lower than ever. The opportunity exists, but knowledge is still uneven. And knowledge compounds too. If someone understands early in life how retirement accounts work, how employer matches function, how tax advantages accumulate, their financial trajectory looks very different from someone who learns those lessons 20 years later. The system rewards early awareness. It also rewards resilience. Recessions are part of economic cycles. Companies fail, industries decline, new ones rise. Creative destruction is uncomfortable, but it has historically driven innovation. The key is not avoiding every downturn. That's impossible. The key is building enough flexibility to survive downturns without being forced into bad decisions. Emergency savings, reasonable debt levels, diversification. These aren't exciting topics, but they are powerful stabilizers. Because in crisis moments, forced selling destroys wealth. When someone has to liquidate investments at the worst possible time to cover expenses, losses become permanent. Liquidity gives you breathing room. Breathing room protects long-term strategy. Now zoom out again to the global picture. Capital flows across borders instantly. Investors compare yields across countries. If returns look better elsewhere, money moves. That movement affects currencies. It affects trade balances. It affects inflation. When the dollar strengthens, imports become cheaper for Americans, but U.S. exports become more expensive abroad. When it weakens, the opposite happens. Currency dynamics ripple through corporate earnings and market performance. And behind those movements are expectations about growth, interest rates, political stability, and fiscal discipline. Fiscal policy is another powerful force. When governments spend more than they collect in taxes, they issue debt. That debt must be absorbed by investors. If demand is strong, borrowing costs stay manageable. If demand weakens, yields rise. Rising yields increase interest expenses for governments, which can lead to difficult budget decisions. Debt sustainability becomes a long-term conversation. None of this happens in isolation. When central banks raise rates to fight inflation, borrowing costs increase for households, businesses, and governments simultaneously. That's why economic adjustments can feel widespread. It's one system with multiple pressure points. Now let's bring this back to something practical. Imagine two individuals. One spends most of what they earn, carries high-interest debt, invests sporadically, and reacts emotionally to market swings. The other saves consistently, invests in diversified low-cost funds, keeps debt manageable, and ignores short-term noise. Over 1 year, their outcomes may not look dramatically different. Over 30 years, the difference can be enormous. Not because one had secret information, because one aligned behavior with how the system actually works. That's the quiet advantage. Understanding that markets are volatile but historically upward over long periods. Understanding that fees quietly erode returns. Understanding that leverage amplifies risk. Understanding that inflation slowly reduces purchasing power. Understanding that tax efficiency matters. These are not secrets, but they are powerful when applied consistently. Now let's talk about risk in a more nuanced way. Risk is not just volatility. It's not just seeing your portfolio drop in value temporarily. True risk is the permanent loss of capital. It's taking on leverage you can't sustain. It's concentrating too heavily in one asset or one company. It's depending on optimistic assumptions without margin for error. Professional investors talk about risk management constantly because survival is priority one. You cannot benefit from long-term compounding if you exit the game early due to catastrophic loss. That principle applies personally too. Sustainable strategies beat aggressive, unsustainable ones over time. Another overlooked concept is optionality. Optionality means having choices. Savings create optionality. Low fixed expenses create optionality. Strong credit creates optionality. When opportunities arise, whether it's starting a business, buying an asset during a downturn, or changing careers, optionality gives you flexibility. Flexibility is underrated wealth. The financial system will continue evolving. Technology will change how transactions occur. Artificial intelligence will alter analysis. Digital payment systems will reduce friction. Regulation will adapt to new risks. But fundamentals will remain. Capital seeks return. Risk requires compensation. Leverage magnifies outcomes. Confidence drives participation. And time compounds everything. If you step back, the entire system is a network of promises about the future. Loans are promises to repay. Bonds are promises to pay interest. Stocks are promises of future profits. Currencies are promises backed by governments. Even insurance is a promise to pay under certain conditions. The system functions because most promises are honored most of the time. When too many promises break simultaneously, crisis emerges. That's why transparency, capital buffers, and regulation exist. They are attempts to strengthen trust. But trust ultimately depends on human behavior. Integrity matters. Incentives matter. Accountability matters. When incentives reward excessive short-term risk, taking without long-term consequence, fragility builds. When incentives align long-term stability with reward, resilience strengthens. As an individual, you can't redesign the entire system, but you can choose how you interact with it. You can choose not to chase unsustainable returns. You can choose not to overextend yourself with debt. You can choose to prioritize steady growth over quick wins. You can choose to educate yourself continuously. Financial literacy is not a one-time event. The system changes. Policies shift. Markets evolve. Staying informed without becoming reactive is a skill. It means distinguishing between signal and noise. Headlines are designed for attention. Long-term wealth is built through consistency. At the end of the day, the financial system is neither hero nor villain. It is a framework. Within that framework, some participants thrive, some struggle, and most fall somewhere in between. The difference often comes down to understanding. Understanding how money is created. Understanding how credit expands and contracts. Understanding how markets price expectations. Understanding how compounding magnifies both mistakes and discipline. It is focusing on what you can control instead of obsessing over what you can't. Control is a powerful psychological anchor in finance. You can't control the market's daily movement. You can control your asset allocation. You can't control inflation headlines. You can control your spending rate. You can't control global liquidity. You can control how much you invest consistently. Consistency is underrated because it's not dramatic. But drama rarely builds durable wealth. Now think about legacy. Money is not just a tool for consumption. It's a tool for optionality, security, and generational transfer. When managed intentionally, capital can outlive its creator. Businesses are passed down. Investment portfolios continue compounding. Insurance policies provide stability. Trust structures transfer assets across decades. That long-horizon thinking changes behavior. Short-term speculation fades in importance when you think in decades rather than days. The financial system rewards those who align with long-time horizons because compounding needs time to express itself. This doesn't mean ignoring risk. It means managing risk intelligently, holding some liquidity, avoiding overconcentration, keeping leverage at sustainable levels, understanding tax efficiency, reviewing strategy periodically without constantly overhauling it. These behaviors don't trend on social media, but they quietly build stability. And stability creates resilience. Resilience is what keeps you invested during downturns. Resilience is what allows you to avoid panic selling. Resilience is what separates temporary losses from permanent ones. Zooming out one last time, the financial system is an evolving network of agreements about value, time, and trust. It has flaws. It has strengths. It creates opportunity and occasionally crisis. But it remains the framework through which modern economies operate. If you choose to ignore it, it still influences your life. If you choose to understand it, you reduce uncertainty in your own decisions. You begin to see patterns where others see chaos. You begin to recognize that volatility is not always danger. You begin to understand that wealth is often built quietly, not loudly. And most importantly, you realize that while the system is complex, your strategy within it does not need to be. Earn steadily, spend intentionally, save consistently, invest broadly, keep costs low, avoid excessive leverage, stay patient, adapt when fundamentals change, not when headlines scream. Over time, that approach aligns you with the underlying growth of productive economies. The financial world will continue to evolve. Digital currencies may reshape payments. Artificial intelligence may refine risk models. New regulations may alter incentives. But the foundational forces will remain. Trust, incentives, risk, return time. Mastering those concepts gives you perspective. Perspective reduces fear. Reduced fear improves decisions. Better decisions compound. And compounding, more than anything else, is the quiet force that shapes financial destinies. At the end of it all, the system is powerful, but it is not mystical. It runs on agreements and incentives. Once you see that clearly, you stop feeling overwhelmed. You stop chasing noise. You start building deliberately. And that shift from reaction to intention is where real financial confidence begins. Not in predicting the future, but in preparing for it. That is how you move from being carried by the financial system to navigating it with purpose. And in a world built on belief and expectation, purposeful participation is one of the strongest positions you can hold.